Oh, yeah, yeah. Friday night. Sharon, how are you? Good, thank you for coming. Yeah, see you as well, Mike. Hi, I'm Sharon. Intel.
Got a glimpse of their park.
Yeah, I got a heard that.
Why they want
I was gonna say, yeah, it's like so much uniform. Let's not be.
rolling?
You're on I mean, they're fine. I think she's. Oh, really?
All recovering.
Yeah.
You don't credit, you don't get credit, you know, you bank and credit, so.
Yeah.
Most of them is all running to my.
Residential sales, they were all. Residential.
I'm a resident.
Yeah. Yeah. I was like, and they're like, yep. Even the bank, the title company, yeah. That was cool. I like you.
Hi. Well, awesome. Yeah, we have a argument.
Yeah. Like, she said when I walked in, I'm like, oh, Jackson.
The politics was the face to face.
Yeah.
I always stop.
Yeah.
Stop, like, send us an update and stuff, so.
Yeah, nice to meet you. Absolutely. You got like some food?
I've got.
I'm good too.
I just ate, so. Yeah.
It's so much food, yeah. Well, this day, like, or do you want to have everybody back here standing?
Yeah, I think that's probably just.
You want to sit? Well, they're kind of weird chairs, but they work, so. Oh, yes. Left. My light. I come in.
Williams.
Hi.
Yeah, that lines up. I worked for Anchor Bank, National. Going back up here, I'm kind of like, this is familiar, but different. Yeah, yeah. I think this is like our deposit operation, so I didn't get up here very much, but yeah, yeah. It looks really nice. Yeah. Oh, cool.
Moving out of this.
Yeah. Absolutely.
Yeah.
One of our. Yeah. Seamless, my first. Like. Yeah, they have.
A lot of. No, just. I gotta come here.
Oh, you have like one thing, like, not maybe put a busy operation, you know, my. One who teaches her, like, then before that, I had like, so preparing you, you know. My God, I don't know how to do this. So what? This, yeah. I've never been involved with that.
It's overwhelmingly.
I'm sure it would have been super early because of that, like, I later on or something. Should have been, but yeah. Like the kids would have been, I'm like, oh, I'm supposed to say.
Yeah, yeah.
It's the only way to get through those hours. Yeah, you feeling overwhelmed coming back or is it okay? Grab a cup of coffee. We're doing a good one.
Stop.
Oh,
Yeah.
Okay.
Like,
I never have.
like, you know, or
Okay. How much do you want to smoke? I guess we kind of see it on store.
Like,
Okay. I suppose you already others, you know. Okay. Yes. Yeah. Good. In this building? No, completely different. Where are you? Yeah, that's what I thought. So you, every day or just when you need to? Okay. Yeah. Yeah, 2 miles, the Hudson Ranch, that's right, so 2 miles to there west. And then South connected 4 miles, that's fine. Countryside village. All that land. Yeah. 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 You know, no. Don't eat, you're on the north side, I'm on the south side. Yeah, so here's another way to explain it. So if you took the roundabouts are in Hanley and you headed east, and you know, take a left from Mandator, do that, go straight to that stop sign there, like Brickell is. Right up there. Yes.
They spent like a month.
Oh, okay. Oh, sure. Yeah, that's Chuck Jarrett. So we used to live up there. Yeah. Do you know Chuck Jarrett? Yeah, yes. So, but I guess my mom has too close to home. I still work at home 50% of the time because I go in and it's just like, you know, here, give me, yeah. I haven't seen this guy in a while. He just had, I was out for a couple months. Yeah, he was out for a couple months. So welcome back. Yeah. Yeah, they're first.
Right, instead of a hard stop. So we'll get everything. All right, guys, we're gonna get started here. All right, so we are very excited. We have a great, we have guests here today that have joined us from Royal Credit Union. And they're here to talk about storage units and buying storage units, owning storage units, what the bank looks at with storage units, and really just give us a really good overview in terms of investing in real estate. So we have them for the next hour, so make sure if you have any questions, they're willing to share. So make sure you ask your questions, and I personally do a lot of business with Royal Credit Union. I think I have like, I don't know, 6 investment properties right now. And so I love Royal Credit Union. They're always my go-to lender to talk to when it comes to real estate, and we're super grateful that they're here. So we've got Brooke, Joe, we've got Scott, and Jack. So can we, give them the next hour and. All right.
All right, well, I'll kick things off. First of all, thank you for having us. We're super excited. Like Lisa mentioned, we like getting out and about educating folks, work with a lot of realtors. And so we're gonna focus on storage units today, but Scott will touch base on a couple of his slides or a slide. We do a lot more than that. I'll let him steal the thunder, but Joe Fisher, I'm a regional manager for Royal. I lead a team of commercial lenders in Western Wisconsin in the metro market.
I'll go. My name is Brooke Jackson, Treasury Management Officer with RCU. So after they do a little bit about lending, I'm going to talk about business banking products and services and a little bit of broad trends that we're seeing out there. So very just general business banking things. I office out of the New Richmond office and cover all of the St. Croix Valley.
Scott Jones, commercial lender. I office out of Hudson. I've been with Royal for 15 years. And we appreciate the partnerships that we have with Keller Williams. And as Lisa said, we do a lot of partnerships with her as well. And, forward to sharing our knowledge on self-storage, but beyond that too, just, commercial real estate investment properties. As I tell all my clients, we're not everything to everyone, but we are very good at certain things. And real estate investment properties are one of the things that we have a very good niche in. Jack?
Yeah, Jack Linson, also a commercial officer with Royal Credit Union. I'm based in our Little Canada office, so right around St. Paul, but I get to Apple Valley all the time. I was just here this morning, got several clients down here. Really just echo everything Scott said. We're in the same position and just looking to get to know more people and help out more members.
All right, I'm gonna start us off slides. Brooke, you are on the remote control duty there, so I'll let you do that.
Sorry.
Maybe. We'll keep this pretty fluid, so we've got some content here, but feel free to pause us, stop us if you have any questions. We're willing to dig in. This is what we thought you'd like to hear, but we'd love to learn what you would like to hear.
Yeah. So you heard about us personally, what our roles are with Royal Credit Union, but who is Royal Credit Union? You may not be familiar with us. So we're 5.7 billion in assets. Again, that might not mean much to you. What does that what does that mean to our clients though? It means that we're not so small that we can only do one loan with you and then we're maxed out lending capacity, but we're not so big that it's the corporate approval process that takes months. Kind of right in that sweet spot for both an employee with Royal and also for our clients. It really does hit that sweet spot. So our lending capacity is 60 million. Not that we want to do one loan at 60 million, but point is we have many clients that grow with us to that point. So you don't have to be working with, oh, I did a $2 million loan here, they're maxed. Now I got to go someplace else. You can stick with us all the way up to that amount. And believe it or not, some of our real estate investors have an ambition to get 60 million in debt. But investment real estate debt means income. So, we have over 300,000 members. We have 27 locations throughout Western Wisconsin and the Twin Cities. So, and we have a location in Apple Valley. So there you go. That's our footprint. And yes, we're right there as well. So next slide. All right. So commercial lending at Royal. Again, we have been doing this. We're specialized in commercial real estate. We certainly do other lines of business as well, but we do that very well. Our portfolio in commercial lending is 1.7. It's up there, but I'm not reading it. So 1.7 billion. We've been doing this for 40 years. We have a lot of experience, and we can, tailor our loans to try to meet your needs. So I miss on this side. We make our loans, our decisions in-house. We service our loans in-house. Our loans aren't sold, secondary markets or anything like that. So, yes.
Just curious, what's a SBA 504 loan?
Yeah, SBA 504 is utilizing a government program where they step in and help with down payment and long-term fixed rates. So it's and self-storage qualifies for it. Typically, it's owner-occupied properties, but they consider self-storage in the owner-occupied realm. And so it's a good option to get a long-term fixed rate, and you can oftentimes get in at a lower down payment.
Question too.
Yeah.
Can you go is there if you make the numbers make sense, can you go with 10% instead of 20% in commercial? Can you diversify? Because that would help you diversify faster, essentially. If you had $2 million.
Yep, correct. But the answer to that is no. SBA 504 is going to get you in for the least amount down, and that's going to be 15% down minimum. Then going traditional financing without SBA, you're going to get 20% minimum.
There's no way to get less than 15.
I mean, there are strategies or ways, seller financing, we won't get into that today, but additional leverage that way, partnerships. But as far as a conventional loan, we cap at 80% loan to value. So, 80% loan, 20% coming elsewhere.
And to be honest, you're going to run into the cash flow challenge before you run into the minimizing that down payment. So if you are leveraged at 90%, well, that's more of a payment that you have to cover each month. And typically the cash flow isn't going to allow for that to be done unless you're at a very seasoned property, but you don't get to a seasoned property right away. So hopefully that helps with that.
If you want, we can send more information on the 504 program. We partner with CDCs, and so to do an SBA 504 loan, we need a third-party partner. We have a preferred one. There's a couple in the cities here, but like Scott said, it's 51% or more owner occupied, and storage units fall in that space. But we can definitely share additional information on that.
So what's another product type that I would be surprised to hear that a 504 will fund?
It's really owner occupied, and then self-storage is that unique one.
Okay,
That's
kind of it.
Yeah, and you could have like a warehouse and office space if your business occupied 51% of the space. Now, the challenge with it is when they underwrite it, and it has to qualify on just that 51% and not on the additional rental income, but that's about the only one in the bucket that I can think of
It's
that.
always been an odd one. It is a head scratcher that I'm surprised they allow it, but
Yeah,
it's nice that they do. So, and then, well, that's good. And then on the bottom there, you can see, well, we're talking a lot about self-storage today. We finance multiple other investment real estate, apartments, retail, industrial warehouse, all those types of things.
And on the commercial side, it's not on here. We actually stripped a couple slides out of it, but we do mention, in-house SBA longer term swap rates. And so your traditional or conventional in-house commercial loan, they're 5-year fixed rates amortized up to 25, maybe 30 years on multifamily. And so slight difference from home ownership, right, where they're 30-year long-term fixed rates. Ours, just like many other of our competition, are 5-year. A lot of them have balloons on them. That's one of our competitive advantages at Royal is we'll only commit to a rate for 5 years, but we commit to the full term of the loan. So we'll actually write your loan for 25 years. Where on the commercial side, a lot of our competitors, banks, credit unions, they'll do 59 payments with a full balloon payment. Now, really, in reality, what happens is they just rewrite that loan or renew that loan. So we like to commit to the deal on most. There are occasions where we would write a balloon, but that would be to mitigate some risk. Or if there's a larger tenant, again, that's not in this storage unit space, but there'd be reasons that we'd write a balloon, but most are fully amortizing. Go ahead.
So if the rate's fixed for 5 years, what index are you going off of for the adjustment of the rate? How does somebody know it's gonna be?
Yeah, don't get Scott on this one, but no. So we've been doing it for a long time. We really put a floating rate on there. It's prime. And the purpose really isn't to give a floating rate in perpetuity, right? That's not the goal. It's a placeholder so then we can hold that mortgage and that commitment out. So it's prime. I'd say 99% of our borrowers, especially in today's rate environment, today's rates are in the 6s, maybe some in the high 5s today, where prime is obviously greater than that. So we put it out there for a placeholder. Now, when rates were 3s, right? And we did have some borrowers that selected to float, but after 5 years, we float typically at prime plus or minus a small delta. Good question.
Questions? All right. Check the next slide.
I lost power again.
Oh, I don't know if I'm it'll be above my pay grade.
Oh,
Yeah,
boy.
sorry.
Yeah.
Oh, it worked.
Clicked,
Oh,
you got it.
other way. Is that right?
Wrong way.
I didn't do anything.
That's all right. While we work on that,
Yeah.
the next slide is why do lenders troubleshooting it back there?
Does it work now?
No.
Why do lenders like self-storage? Why do our clients like self-storage? Occupancy, stable cash flow. Those are a couple of reasons. Good occupancy has not always been the case with self-storage, but over the last 10 years, it has really seen stable cash flow, stable occupancy. Of course, there's also lower operating costs. You think of an apartment, there's much higher operating costs with an apartment, meaning perhaps a property manager. Here we go. I'm on that one right there. So you don't need as much staffing for self-storage.
I'll hit it more often.
You, without technology and historical mom and pop operators, they wanted a on-site manager a lot of times. You can leverage technology where you don't need that anymore. So, and maintenance is less too. Maintenance on a steel self-storage building, a lot less than an apartment that takes a lot more wear and tear and carpeting, painting inside and redoing cabinets. You just don't have a lot of those costs. Recession resilience, seeming so right now. I mean, we've seen demand go up when the economy comes down slightly. Again, it hasn't always been that way, but in this current environment, it is seeming that way, that it is a little bit more resilient than other real estate sectors. And then, it is a tangible asset which holds its value and has been increasing in value significantly over the last 10 years. All right, so the outlook on self-storage. I guess I'm gonna go back to, let's say, 20, 30 years ago, where it was, where we're at today. So it started with, again, a lot of these mom and pop operators throwing them up. They're cheap to put up, and a simpler asset class than apartments and industrial and warehouse and things like that. So, but they were fragmented for the most part with lots of operators. You'd have again, that on-site stores manager, not a lot of technology, unsophisticated operation. The communities really weren't thrilled about them either. They had a bad reputation, crime, seedy operations going on within these storage facilities, businesses being ran out of them. That has now changed as we're progressing through this whole cycle of self-storage. So where we're at today, they're becoming more sophisticated, they're leveraging technology. The operators are putting in security, gates, key-coded entry. The clients want this. They want clean facilities. They want facilities that are kept up, looking modern and up to date. And with that, they're getting a better reputation. You put in all these tools to make them more secure and monitor them. Well, you have less crime. And occupancy, as I said, is pretty stable right now. Cash flow is good. So things are looking good. But the mom and pop operators are getting squeezed out by the larger operators. It's no longer fragmented. The big are getting bigger. Consolidation is the name of the game. Obviously, there's the big ones that have been around, like Public Storage. They've been around for quite a bit, but there's a lot of others coming in and gobbling up these smaller operator locations, then investing into them and making those improvements to keep up with what the market wants and also help them generate more cash flow, charge more rent. So that's where we're at today. What does the future hold? I think there's going to continue to be opportunities for investors to buy these smaller operator locations. These, people that just don't want to adapt to technology. They're not going to do it. I have one right now with one of my clients that they're buying from these mom and pop operators that have been there 20 years. They live on site. They've lived on site for 20 years. And they meet with the person, they give them the padlock, sign the paper, and you get the checks in the mail. Yeah, you can streamline things so much if you leverage technology and put a little investment to these older properties. And part of the reason why these small operators are selling is they're seeing that they're losing market share to the others that have adapted. And they're just like, no, let's sell it, be done. So there's opportunity out there, but it's going to take the purchase of it and then investment into it to make it work. So in general, I would say it's a good asset class. I've financed a lot of these over the last 10 years. Watched people grow some very sizable portfolios in this asset class. It's been fun to see how they do it, and they have just continued to leverage streamlining activities. And there's a lot of programs out there, software programs that help you manage your occupancy and cash flow and all that. That could lead to market saturation. Are we there? No, it depends. It depends on every community. You want to find the right location and make sure that you are going to have something either that differentiates you from maybe the small operators that aren't doing it right, how are you gonna do it better than the others? What's their occupancy? You can literally call and say, I'm looking to rent and, secret shop a little bit. What are they charging for rents? Do they have occupancy? And figure out if there's an opportunity out there. There still is, I think. Americans love their junk, let's be honest. They cannot get rid of it. I've asked my clients who have done a lot of this, I said, on average, how often do these people show up once they rent these locations? It's a layered answer. He says, you're gonna get 10% that show up way more than you want them to. You're gonna get another 10% that show up once a month. That's kind of what you would expect maybe for these people paying a fair amount of money for these storage units. And then you get the remaining 80% that never show up after they put grandma's stuff in there that they couldn't throw away. Never see them again. ACH is taken out of their checking account on a recurring monthly basis. The client doesn't think about it. The property owner doesn't have to think about it. Pretty seamless. So yeah, I don't see it declining given, to be honest, prices of housing is going up. Houses are getting smaller, probably with storage areas getting smaller, but people still want their stuff where you put it. Self-storage. So
We had a couple questions on this side of the room. Scott, I saw some hands.
okay, yeah, I was just word vomiting there for a while. So yeah.
So I'm just curious because I know in my community, you talked about potential market saturation. So in my community, which is in Grove Heights, the city council won't approve any new self-storage units. So it could be lucrative because if you want to self-store in Inver Grove Heights with the right facility, you're not going to be getting more competitors and there'd probably be more demand. So how do you, and maybe you do or don't, but from a lending perspective, do you help clients navigate figuring out what the city's viewpoints are or any roadblocks from the city around those self-storage units?
Yeah, it's not our role to, try to figure out what any municipalities' rules are. Obviously, they need to allow it. We can provide guidance, like, explain to the community that there is there's metrics out there. For every so many households, there is a need for a certain percentage, and I don't know those, but those can easily be found. We have some links in here to that, but there is a need for a certain percentage of self-storage. By not having that, you are just creating clutter outside these homes. I mean, they need to sell it to the community, but ultimately they're not moving on it. It's not going to happen. You need to sell them on the things I talked about. It's not the old storage from 20, 30 years ago. It's the new modern storage and secure, gated, fence around the whole thing. We'll make it look nice. What do you want? To make this look nice. Work with some other storage operators to kind of break through that barrier. If they're just saying no, tell them why they need to do this and where is the right fit. If that doesn't work, then I would say you locate just outside of Inver Grove Heights. And I guess I'd be surprised if there aren't people already doing that. If it's not allowed there, I'm guessing.
Well, they won't allow any new buildings. So if you can
Okay.
get an existing facility, it could be lucrative.
Oh, I see.
I know someone else had a question, but I had another question, so I don't know if you want to.
Not a question, but you can go ahead.
Oh, okay.
We'll also see, like Scott said, sometimes you have the municipal jurisdiction that, joins a township. And so we'll see, especially, I'm just thinking Western Wisconsin, there's a lot more storage units typically getting built in the township because they're more flexible. It says sometimes like Inver Grove Heights, they also have to be protective of their land and, they've got land use plans, right? They go out for a number of years. And so they have the perfect plan for this piece of land. And so a lot of our borrowers will, either acquire an existing facility that maybe can expand onto the adjacent lot, which probably is more palatable to the municipality than if you were to build on another one. Otherwise, we just see okay, if not Inver Grove, then what's the nearest community? Typically they say the renters of storage units, the majority of them want to live and access their unit or live within 15 minutes of their unit because they want to access it. Now, like Scott said, the reality is the majority don't even show up, but they like to know that they could visit the site. Yeah.
So the other question that I had was, you mentioned that when you are acquiring these facilities and they may need some upgrading and some other things, when you look at a deal with clients, what do you recommend that they also have in terms of cash on hand in order to modernize or do some of those upgrades to make it a little bit more turnkey, if you will?
Yeah, we're gonna touch on that a little bit more in a few more slides, but yeah, you need to come up with a business plan. Like, okay, you're gonna buy it for 2 million, but I need to put 200,000 into it for what? These things, and that we want to know what that's going to do to the property physically, but what it's also going to do operationally to the property. So yeah, here's how it's been operating, Mr. Lender, and this is why it's not working well, because they need X, Y, and Z. That's going to cost 200,000. Once we do that, we're going to be able to charge higher rents. Here's the property down the street. This is what they're charging that have already modernized. You know, we're going to save money on all these points from what the current owner is doing to what we're going to do. So yeah, you need.
We can, I mean, we see that happen in a number of different ways. You know, we could, some of our borrowers like to pay, just buy the facility and then make the improvements with their own cash. And then you can come back, because every time we lend more money, we have to get an appraisal. So there's additional costs that go into that. It's just some will come in, and Scott knows this because one of his clients does a lot of this. He'll go in and buy value add opportunities, right? Under market rent, maybe a little bit of tire, need some lipstick, surveillance, cameras, gates, stabilize the property or get it leased up, increase rents, and then you come back in, and then we really don't look at the cost. So if it was 2 plus 200, where you could come in and we'll go through kind of how to calculate an NOI or cap rate or a value. But some will take that approach where they will do the work up front with their cash and then come back in for financing afterwards.
And that touches on maybe one of your questions earlier, like you want to get the ball rolling with multiple of these and minimize your down payment. Well, there's a limit to what you can do there, but you can get that property, get it operating better than it was. You paid again 2 million for it, but it was 2 million based on poor operation. Now you got this thing operating wonderfully. It's now worth 3 million. Come back to us and say, hey, can we get an appraisal? Can we leverage this property to buy the next one? And that kind of goes for any asset class, honestly. And we see that a bunch is leveraging.
Can you also exchange a property into a loan to be able to buy a bigger property?
Change a property.
Like you say you have a property, you sell it for $1 million, and then you exchange it into a $5 million property.
Oh, 1031 exchange.
1031 exchange, but you are willing to work with that as a down payment, or?
Yeah, we do 1031 exchanges and we work with those all the time. We
You
love
can-
them.
you
They
can
keep
move
the,
up the
they keep the engine rolling of the real estate engine. It just keeps the money flow going.
So you can move up, it doesn't have to be another $1 million property.
Oh, of course. Yeah, just need to prove out the cash flow and have enough down payment and all that stuff. Yeah. There are other questions. Yes.
So, it's kind of, I don't know if you guys are kind of answering this with her last question, because that was kind of my question. But I'm wondering how's the financing working when you come back for essentially the equipment for like the surveillance, the gate, the operational things to advance the facility. Are you coming back for like a equipment loan, or are you coming back as another real estate loan?
Another real estate loan. Again, 2 ways to do it. You could roll into that original loan, and then it's kind of a construction loan, honestly. It's instead of basing it off 2 million, we're basing it off 2.2, because that's how much you're spending on it. We'll do 80% of 2.2 million. Or we'll do 80% of 2 million. You do the 200,000, you come back later after you have it operating, better, and then we'll cash out potentially even more than 2.2, because I'm guessing it would appraise, typically would appraise, let's say instead of 2.2, it'll appraise now at 2.5, because got more operational efficiencies and more cash flow going for it. But
So the tech would be included into the actual construction of the real estate?
Yes.
Yeah, I mean, the tech really, I mean, if you think about it, it's improvements to real estate, it's the fence going in the ground, the surveillance going on that. And then a lot of your platforms, easy storage, storable, there's tons of them that are just kind of out of the box CAN systems that cater to the storage unit. Those are monthly subscriptions. And so really, when you think about tech, it's a lot of it's attachments going into the facility versus, you know, big dollar spends on, things that aren't attached. And so we treat anything that's affixed to the property as real estate.
Typically, what I see what you're gonna be spending money on the most is gates, fencing, the asphalt driving area, you know, usually is in disrepair in some of these older properties that you want to fix that up. Sometimes drainage, yeah, I have good drainage away from the units. Yeah, those are the things. Yeah. Joe, I think you got it from here.
No idea what is going on here. I hope the rest of it is not like this, but this slide looks weird. Sorry.
We'll take it. We'll get a slide deck out in PDF format
Yeah.
too afterwards, but how many of you own storage units right now? Awesome. How many want to buy storage units? Yeah. So this slide, and it's got 3 sections, so you can't see the third one, but really, a lot of it is you can either buy an existing facility like Scott said, or you can build a new facility. Obviously, the easiest way, more turnkey, other than maybe some updates, is to buy a facility. And so one thing that we do is we underwrite all deals. And so what we run into oftentimes is maybe a buyer asking, what's it worth, right? Or what should I pay for it? Or we'll get an appraisal. Unfortunately, that's typically after the purchase agreement, right? Because the purchase agreement's executed before you bring it to the lender. And so a lot of what we would encourage is pay for what the property is producing today, right? Don't pay for the work that you're going to do or the value add that you're going to do. Use that as your gain. But we see a lot of properties get sold based on value adds or performance based. And so, and again, brokers, realtors, you know, that's their role is right to represent the seller and get as much money. And so we see a lot of that. And so one thing that we always do is make sure you're running the numbers current, make sure it works, make sure the leverage, and we'll do the same as a lender to make sure that the leverage as is or as is cash flow will support the project. And so don't overpay. You guys probably hear a lot of that during your wealth building strategies too, is there are scenarios where you should or could if there's that much opportunity, but make sure you're buying it right. That's where you make your money, is on the front end. Red flags or and some upsides. So just some red flags, high delinquency. So, you know, if you see a facility out there and it just seems to be a screaming deal, understanding the why, you know, why is there high delinquency? Is it just poorly managed? Is it in a weaker location? Just like everything else, location does matter in storage units. Some maybe not as much as others, but is there deferred maintenance? Like Scott said, you know, the parking lots, the doors, you know, some of these facilities are now 30 years old, and every piece of it just slowly adds up. It's steel. There's a lot of the older buildings have steel screws every 12 to 18 inches. Those need to be replaced or resealed. And so just some of those things, deferred maintenance. If you're buying an older facility, just make sure that you understand the cost that will need to go into it, because either that will need to be come out of cash on hand or potentially more debt on the property. As far as due diligence materials go, and so that's really, hey, what you should be asking the seller or the broker that's helping assist with the transaction is really reviewing the rent roll, get a good comfort level of it. You're going to want occupancy trends, a T12 or a trailing 12, cash flow statements. And really the T12 or trailing 12 or 3 years of tax returns will show you how the past operator operates, both on the income side, but then also what they're doing on the expense side. And so what can you do if you acquire a property or take over a property to reduce that expense? So a lot of them, I mean, even the newer facilities, third-party property management, additional expense, right? You know, if you're doing your own lawn care or you're paying, you know, all of those things. And the big things are taxes, insurance, lawn care, snow removal, surveillance, tech. Am I missing any? I mean, there's really not much. That's really the big brunt. But are there ways that you can reduce the expenses? And then as far as rent rolls go too, and it's not in this slide, but just doing a market analysis on the area. So are other facilities at 95, 98, 100%? And what are they renting for? Is the facility you're buying higher than market rents, lower than market rents, or at market rents? Oftentimes, if they're higher than market rents, they're probably in a better location, better managed, better amenities, surveillance, freshen up, or maybe they're in weaker areas with weaker tenants. So the rent roll will only tell you what they're supposed to pay. It doesn't tell you if they're delinquent or not making. And so when you're looking at a rent roll, you can ask for a delinquency report too. And those are a report that's easily generated, but make sure you kind of know who the client mix there and who you're dealing with. As far as valuations go, just high level, a lot of what we do on lending or even how values are calculated is based on net operating income. Does everyone know what NOI is? So, yeah. So income minus expenses, NOI. And really that's cash flow that you can pay your debt, right? And so cap rates, there are some industry standards for storage units. 7% is what's on here, but honestly, it ranges from the Twin Cities market to the St. Croix Valley over to Eau Claire. And so really it's dependent on location, age of property, all of those other things, but really your NOI divided by the market cap rate is the driver of your property. So, and same as I mentioned a few minutes ago, just don't overpay for future performance, pay for current performance and take the gain on your value that you bring to the deal. I've got market trends on here. Scott did a good job explaining that. But again, if you find a facility or if you're looking at a facility, again, make sure you know the area. Is the market growing? Is the population growing? Are there competition coming in? Because some of these larger outfits are coming in and putting 400, 500 units online at one time. And so it takes time for the market to absorb that number of units. So if the housing market's growing by 500, there's probably a demand of 40 units, right? And so it grows in proportion, like Scott said. I don't have the statistic, but for every house or every 100 houses, there's a need for X amount of storage units. So make sure that the market's not oversaturated. I've got scenario modeling. And so again, if you're buying a deal as is, and it works, great, continue operations, it works. But if you're doing a performance, say, hey, I need to increase rents, reduce expenses to make this work. I need a bank on a 3% interest rate 5 years ago, right? Today they're in the 6s. That's a real deal. I mean, your loan payment is one of your largest, we don't call them expenses, but it's out of cash flow. It's a cash outflow. And so make sure you're modeling or stress testing that, because you're likely going to have debt on the property for 20, 25 years. That's what we typically amortize. And so we always say stress test, and we do it. We stress test, even if you're buying a property with 100% occupancy, we still deduct the vacancy because market has vacancy in storage units and other properties. Insurance. We've got a bunch of hail recently in a lot of our markets. Insurance is increasing. Taxes, I can assure you, will typically never go down, right? Those get higher. So just make sure that you're stress testing that, making sure that as you're modeling it, that your rents are going to help keep pace or outpace some of those expenses. And then the last one is sensitivity analysis. And I mean, don't over-engineer something, I guess, over-engineer based on your risk appetite, but you could stress test any expense. You could stress test any income line item, but make sure that you go in preparing for the best, but then also preparing for slightly less if needed.
You want to sell yourself sell the deal, and yourself. That's part of the deal is yourself, but sell why it's going to work to your lender. Because we need to sell it to our loan committee to get approved. We are paid and bonus to do deals. We always want to, Jack and I, we always want to do deals. But we also know we're that gatekeeper. We're in between the client wanting to do the deal at, only 10% down at 3% interest rate and whatever to the loan committee. So, bring us a deal and that, you can defend and explain that this is why the numbers work. This is the due diligence I've done. And then we've got something to work with because we want to do deals. It's just, we need to make sure that it makes sense. It's gonna cash flow.
And it's always better when we can get ahead of that underwriter or ahead of the loan committee too. So the more prepared that you're coming to Scott or I, the more that we're able to get ahead of that and just speed things up as well.
Just address any questions or concerns ahead of time, always makes sense. Easier. Okay, here's just a quick checklist. So this isn't for Royal, it's for most lenders, but really an offering memorandum, that's usually typically with a broker packer or a real estate agent will prepare a nice little packet, right, to present. Rent roll, 3 years of financials, T12. Some of the metrics we'll have a business plan. It's not ours, it's through Storable, a third party, but just some of the metrics we look at, you'd want to include those, but NOI, DSCR, which is debt service coverage ratio. So DTI on the home loan side, we're debt service coverage ratio on the commercial lending side. So really it's income expense minus expenses is NOI, and then DSCR, and if this is going way over your head, write it down and find it later. But DSCR really is your NOI divided by your debt payment, and we're looking for 125. So every $1,250, don't have a mortgage payment over $1,000, and you're in good shape. Market position, like I said, local demand, competition, demographics, borrower profile, and so we're a recourse lender, which means that even though you might buy the storage unit or a building in an entity name to provide that corporate veil, within an LLC, we still require guarantees from our owners or guarantors. And then last thing, just again, make sure you're doing your inspections, due diligence, and have a plan for deferred maintenance. All right, this is really a bunch of the same, just giving you some narrative behind it. We already talked, so what lenders look like, including Royal, we always look at the property first. And so we just went through a lot of the property metrics. We'll go through in a second, kind of the borrower metrics. We went through existing facilities. For new construction, just a lot more detailed, right? It's plans, visiting the city, right, to make sure that you can build storage units or not, making sure that it's permittable in that space. You'll have to get a general contractor. Feasibility is not required, but it's oftentimes good, especially if you're building a larger facility. Have a third party come in, provide you market data on does this location work, and is there a demand for this size of location? How long will it take to stabilize? And so instead of guessing, you've got market data that tells you, can give you some knowledge on can the market absorb it? How long will it take to get to stabilization? And then performer, really that's projection based. And so typically we like to see month to month on larger loans or larger facilities, but just watching that going from zero occupancy, still having a lot of those expenses, taxes, insurance, electrical, utilities. How long is it going to take you to get to a break even, right? Some really good spot where cash isn't going out of the checkbook anymore. It's starting to come in. But then ultimately, where do you get to the 125? And then where do you get where you want to be, which is better than 125? That's true cash flow there. But we typically like to see those on a monthly basis because there's going to be a feed in new construction where you'll just have to be prepared that there'll be no money coming in or limited, but there'll still be an outflow of cash needed.
Different municipalities will have different levels of new construction requirements, and you maybe get into that a little bit earlier, but in rural heights, if they ever do allow it, I can guarantee you your cost per square foot to build something is going to be probably pretty expensive because they're going to say, all right, fine, we'll do it, but we want a brick facade, masonry. It's not going to be the steel, full steel building. Right. So just don't see a location and be like, oh, yeah, it's going to be a great spot for a steel building. if it's within a city limits, oftentimes they have higher threshold.
All right, next, like I said, we're a recourse lender. So in addition to the property, we also look at personal. And so really this is just, we would need a personal financial statement, which really is a listing of asset liabilities. Bottom of it, the difference between the two is net worth. We like to see liquidity. Really that is how much cash on hand, right? If everything goes well, which that's what we underwrite. And all of our loans are good on the first day, guys. So we don't make bad loans. And we don't make, I mean, honestly, Royal, we don't make a lot of those, but part of ours is just making sure that there's enough cash on hand to cover any blips in the system. We typically look at 3 years of tax returns. We'll pull a credit report. And then we look at resume or industry experience. So those that don't have experience in self-storage, I would say come with a pretty solid business plan. And we'll get through this in a second, but just make sure that you're well connected. You've got the data and you can answer a bunch of questions, right? That will build rapport with your lender. But we do a lot of, we do a lot with experienced storage unit owners. We also do a lot with more, I'll call them startup, but it's a lot easier to absorb when there's storage units in place already operating. But, all right. As far as Royal is concerned, so we talked a few slides ago what industry standards are. Again, more specific, we typically like to finance 85% plus or stabilized properties with solid cash flows. Again, we do perform a projection-based deals. We'll just have more questions, which we do all the time, and we answer a lot of good questions. But our three main structures are, we'll call it the rule of 100, 80-20. 80% loan to value, 20-year AM, 75%, 25-year AM, 70%, 30-year AM. So the more down, less risk for the lender, longer runway. So benefits of this is kind of the sweet spot where most of our deals are: less leverage, less loan payment for you, a little bit longer runway, more cash flow. But you've got more rate exposure to rate increases or rate adjustments the longer you hold that out there.
If you're sitting here looking at any of this like, whoa, what's all this underwriting? I'd love to just sit down, grab coffee, have a phone call with you. Prior to being a commercial lender, I was an underwriter. So I always try to get ahead of our underwriters a little bit, or at least be at the same level they are. So I'll pass out my card after, but I'd love to sit down with anybody to look at any deals.
We're not going to give Brooke much time left. So loans offered, acquisition, you're buying an existing facility, construction, building a new facility. Permanent financing is really kind of if you have an acquisition where you're going to buy, make improvements, maybe you want some more leverage. We call that a permanent financing. So, hey, we're going to actually put debt on it long term. That could also come after construction as well. Those are in-house programs. Like we mentioned earlier, there's an SBA 504 program, lower down payment. There's also a SBA 7A program. We won't get into the details. That's a whole other 5-hour seminar just on SBA programs. We offer 504. We don't offer 7A. Honestly, conventional 504 would meet your needs for self-storage. I wouldn't go the 7A route. That would be probably last resort. Makes a strong borrower. All the things we talked about, good financials, a good package up front, experience, a good business plan if you don't have a lot of experience, and then willingness to co-invest. So that's your 20% down, the 25% down. So more down in the game, the lot better the lenders feel because there's skin in the game. Preparing for financing. We already talked about some of these. This is really just a recap of it, but do your due diligence on the community that you're looking to either buy or build storage facilities. Conduct a business plan. It seems like a lot of homework, but it's actually a lot of good information that comes out of that. You go through scenarios. Who's your competition? What do the financials look like? What can we do to improve the facility? It's a good exercise to go through. And then work with brokers or lenders like Royal that have experience in this. It's a lot easier working with someone that knows the business than it is going to someone that doesn't. And then again, like Scott said, we've got the capacity to grow. And so that's always our goal, is to continue growing relationships with our members.
we've talked about construction a few different times here. Because if you have not, if you don't have any storage properties yet, I would urge you not to do construction first.
Don't do
But,
it.
Yeah, please don't.
Do it.
Yeah.
Don't do
Do
it.
an existing one first, learn it, and because doing construction adds a whole nother element to it. Jumping right into that, like yeah, you're already trying to learn the storage business and now learn commercial construction, and it's gonna add additional risk that we would be leery about. You're really gonna have to sell it to us why this is gonna work. So take that for what it's worth.
All right, common mistakes, be prepared. Start the conversations like Jack said early. And so Jack's more than happy to have any conversations with anyone. And so if you're interested in learning a little bit more specifics about what Royal has to offer, if you've got general questions about storage units or any other asset class for that matter, start those conversations early. So then we can help guide you in the right direction. When we ask for documents, it's good to return them timely. It just helps with the process. And so typically once you identify, or if you want to start a pre-approval or process, we'll give you a list of what we're looking for. That way we can get you in a good position to lend sooner than later. Neglecting relationships, I don't like that terminology, but it's on here. Really start forming these relationships early. Like Lisa said, thank you for being a member of Royal, but it's easier. It's the hardest deal is the first deal, right? And then you build that relationship, and every deal typically gets easier from there because we get experience, we get to know you, you get to understand how we operate, and it's a partnership. Your lender borrower relationship is. And then last of all, this is a link to business plan. We won't go into it, but it's just from Storable. I would encourage you, if you are looking at storage units, and you're looking for templates, find one that is for storage units. There's a lot of different resources out there.
We're gonna get this to Lisa to share with your group.
I have it.
Okay.
We'll get it to everybody.
Jack, I stepped over your slide, sorry.
No, that's okay. I'm just gonna pass around my cards. Take one, take a couple. Like I said, more than happy to meet with anybody. I'm down in Apple Valley all the time, so.
Often you see like these people that do the value adds and they help the rent and they increase the property value, that they come and refinance with you guys.
Often, I mean, 50% to probably higher than that, probably 70%. I mean, once you get in the investment real estate game, it's addicting to most people, and making money is fun. So unless that first one goes bad, I would say, yeah, most of the time they're going to leverage that property at some point.
And that's really how you grow your portfolio too, because otherwise it's real estate's just a capital intense business, right? It takes 20% down. So, whether it's buying a house or a business or real estate, $1 million is 200,000. So it's not like you just kind of walk into 200,000 every couple of years. And so we see a lot of our investors will do the value add increase and then come back in for a cash out refinance.
As a new investor, is there, other than cap rate and cash flow, is there something that somebody should be looking at in general, like price per door, anything like that? Just when they see deals come about, they would say that, it should be within this range of price per door.
Yeah, well, I attended the session that King was here. What's
Mark King.
Mark King. The 1% rule is kind of the golden rule that's been out there. So whether it's a storage unit at $65 or $85 or $100 a door, that would tell you you shouldn't be paying more than $6,500, $8,500, or $10,000. It's the same application. What I'd say is storage units, there's a slightly higher multiplier that's used just because there's less operating cost in it, right? And so when you talk about Mark King buying an apartment building, we typically see apartment buildings with operating expenses around 40 to 45%. Storage units Scott's got operators in the 20s, but I would say the average is probably 30, 35, because you don't have the carpet cleaning, the toilets, all of that maintenance. And I would say in general, the 1% rule works. And so if you're buying a facility that has 10,000 in rents, it's $1 million, maybe a little bit more than that. That's a good rule of thumb.
before Brooke jumps in, and she's got a ton of good info and we're gonna get out of here on time, but I just want to throw out too, I don't think we've said this yet, but as a credit union, we're a not-for-profit, so that's super cool. Like we're, similar to Keller Williams, I have good connections with some of the agents in Roseville. We have very similar values between our companies, so it's usually a really good experience working with your clients as well as you as agents. So that's something I've just appreciated about working with other Keller Williams agents. And then as a not-for-profit, our profit that we make at the end of the year gets reinvested into our clients, typically through lower loan rates and higher deposit rates. So just wanted to throw that out there as a differentiator we haven't touched on yet.
All right,
right.
while we have this break,
Yeah.
I have a 2 o'clock that I have to step out for. Yeah, it's got a few, yeah. We got a
We
meeting put right on our calendar right behind this one, but appreciate your time.
Guys.
Yeah, we'll share our contact information via email. It can be dispersed, but if you have any specific questions, Jack or Scott or I would be more than happy to help.
Jack and I can hang out afterwards too. If anyone has anything, I will
you.
speak you through my portion of this. So after or as you're getting your loan for your storage unit or a mortgage or whatever you're doing, the lenders will then contact a business banker or a treasury management officer. So then we steer the conversation of how are you going to collect those rents? How are you going to protect your business account? How are you going to earn the most interest? How are you going to pay the least amount of fees? This was a 20-minute presentation into 5 minutes, so here we go. You need a checking account. This information is not Royal specific, so look for a partner, a financial partner that works for you. Are you fee sensitive? Are you interest sensitive? What do you want? What does that look like? Talk to somebody about that. So you need a checking account regardless. Business savings, money markets, CDs, they're all out there for you. I have some examples of how to use the products and services. So I kind of went realtor, storage unit owner examples. So you're going to need your online banking. You're going to need access to it. You can do mobile deposits, check your balances, set up for alerts. This seems very basic, but you need to do it. So a property manager can view all of their rental income and loan balances in one place. Easy. Remote deposit capture, bring the bank to you. So you have an old storage unit that you're going to rent and they're still paying via check. You can have a check scanner at your location. You're a realtor and you sell a lot of houses and you get paid really a lot by check. You can do this versus taking a picture of it or going to a bank location to facilitate your transactions. Online wires. If you need to purchase supplies, things like that, you can send online wires via, online banking versus having to go into a branch or something like that. So, or instead of going to get a cashier's check or a money order, if they want to wire, you can do it online. ACH origination, I want to spend time on this. So in the storage unit world, I work alongside Scott a lot with his members. We will have the conversation of how are you going to collect the rents monthly. Established, you might have to alter how they're paying now. So you might be using now the name is slipping me, but a software of some sort where the people just go and they put their routing and account number in there. ACH can be used. That can be kind of expensive if you're using some sort of software, but if you want to open it up to your tenants to pay you via ACH, you can obtain their routing and account number. That's all you need, just like our insurance, all of those things. When we get those pulled from our checking accounts, that's how they're doing it, is via ACH. So if you obtain your tenants' routing and account numbers, you can pull money. You can also push money. So if you had a reason to pay people, if you wanted to pay your on-site manager, if you wanted to pay the maintenance guy, pay the lawn guy.
Refund their rent.
Exactly. Yep. ACH works in both ways. So you can pull money or push money. I can't say for other institutions, but at RCU, this is 10 cents per transaction. Costs way less than a check. It costs way less sometimes to deposit a check. Sometimes you have to pay per item to deposit your checks. ACH is a really good avenue for electronic payments.
Yeah, I come from another local bank. But the fees are so much less. So just put them side by side. I'm not even saying just Royal versus anyone, but we are super competitive. So
I'm going to keep going. Bill pay. Bill pay is how we're paying our bills, our credit cards. Do that on your business account. It's very safe. Sweep accounts, if you find yourself, I have excess funds. How can I earn more interest? A sweep account is what we're going to look for there. I'll do an analysis of accounts to say yes, this is beneficial. No, this is not. Merchant processing, same thing. They want to pay with their credit cards. They have an avenue to do so. I'm going to keep going. I do want to spend positive pay. Fraud is on the rise. Fraud is happening. It is everywhere. And I am a very transparent salesperson. As a business owner, as a storage unit owner, as a realtor, on your business checking accounts, you are 100% liable if anything happens. As consumers, we are federally protected by regulations to pay back if we are a victim of fraud or someone steals our checkbook and writes a bunch of checks. We as consumers are not liable. As a business owner, you are 100% liable if fraud happens on your accounts. And I'm saying that very bluntly to kind of scare you into this. Positive Pay is a service that most financials offer. And how it works is you tell us the checks you write and the vendors that you work with. We don't know if Brooke Jackson Real Estate is writing a check to Jack. Like, as the financial, we don't know who you write checks to. You could be writing a legitimate check to Jack or to the HOA or whoever it is, to your insurance company, a vendor. So it is our obligation as the financial to pay the checks you write. It's when it gets in the hands of the fraudster. They don't need anything. They don't need to know what check number you're on or anything. If they obtain your routing and account number, whether it's just the routing and account number or an actual check of yours, our mail system is compromised. It's really scary. Things happen. If they have that routing and account number, they can create a check on your behalf, or they can go online and pay whatever they want. Like, it's really just that easy. So be sure, if you have business accounts, please talk to your financial about Positive Pay. It is the easiest and cheapest insurance policy. It's not an insurance policy by any means, but you tell us who you're working with and what payments are valid. And as long as they present, we validate them and pay them. If it doesn't match, we stop it. You don't take a loss. Your account number is essentially not compromised, and you move on with your day. So if you take anything away from what I'm saying today, is Positive Pay. I did a little self-storage package with the same things we talked about. Fraud again. Fraud in today's world. Check fraud is still there. Checks are not going away. It's happening. Account takeover is where someone obtains access to your online banking. So you have online banking and you have ACH set up. They log in as you. They facilitate an ACH transaction on your behalf to their bank account. They deposit it. They pull the money. You're done. Imposter fraud. People will say, hey, it's RCU calling you up. It looks like something's weird. Can you give me your password? Don't ever give your password. Hang up, call back a trusted source. This is happening a lot in the real estate world. Hey, I don't even know. The title company is saying, please send me a wire ASAP. Don't do it. Just don't do it. Call and verify. Don't send wires. Don't, the office manager is saying, hey, you owe us X, Y, and Z, or you didn't pay your invoice last year or last month, for your class or whatever. If you did or didn't. Don't send unless you're super, super sure. Ransomware. So ransomware is someone gets a hold of your systems and they lock you out and say, I'm not letting you back in, and I have all of your data and all of your clients' data. I'm not letting you back in until you pay us $10,000.
This can happen to anybody. It just happened to the city of St. Paul. So yeah, big one. So just not to scare you, but it's happening.
It is. And then phishing scams where they just try to fish for information. Hey, I'm calling about your client, Joe Smith. Can you give me his last purchase? I don't know. I'm making this stuff up at this point, but don't let people fish for information. Make sure you actually understand why someone's calling you. So have strong authentication. So your fingerprint, have us call you back. Make sure you're authenticating in multiple ways. Make sure your systems are up to date, have dual approval. So the office manager facilitates the payment, you approve it, or vice versa, that type of thing. Train your employees, things like this. Encryption, use secure email. Do not ever send your account numbers without it being a secure avenue. And trust but verify. So trust who you're working with, but say, I wasn't expecting that vendor to ask for payment today. Let me give them a call and see what this is about. So we're 3 minutes over. You guys will have all my information if you need help with anything. Jack's information.
If you just click to the next slide, so they can.
Here you go.
There you go. So,
Perfect team.
Thank you.
Really, really
Thank you.
good. Very good information.
We'll hang out if you guys have questions. If you want to stay and chat, we'll hang out for a couple minutes.
Thank you.
Yeah.
We'll get that.
We have some cards here too.
Oh, yeah. Like, that's one they're gonna talk about, your team. Yeah. Oh, that's